Hey, welcome back. It's Nolan Matthias, and today we are doing 5-Minute Friday. And the topic of discussion for the day is the Financial Post article that the Bank of Canada governor wants to avoid housing policy mistakes of the past. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. Okay, so let's start the timer right at 5 minutes right now. So the Financial Post had an exclusive interview with Tiff, Macklem, the governor of the Bank of Canada, on the 16th of December. And what he is saying is that they are watching the housing market very closely. And the reason why they're watching it so closely is because of lessons of the past. Back in 2009, 2010, when interest rates were incredibly low, obviously that spurred on what was considered at the time to be housing market bubbles. And there was subsequently a whole bunch of conversations around who should control the levers that affect the housing market. Should it be the Bank of Canada? Should it be the federal government? Different worldwide central banks have suggested that Canada's real estate market should be more regulated by the Bank of Canada as opposed to politicians. Obviously, there hasn't been a major market crash in Canada, so the desire to want to make that change and the political desire to make that change just isn't there. Obviously, when you see that you have a Bank of Canada and federal policies that seem to work in such a way that there isn't a major market crash in Canada's real estate market, then it seems to make sense that the market is working properly and maybe we shouldn't be moving and changing things very quickly. Now, it's interesting because one of the obvious side effects of when interest rates get really low is that people start spending money on things that they are required to use credit to buy. And housing is basically the major component of that. The thing that most people will borrow money to buy is a house. So obviously, when you see lower interest rates, there's going to be a spurred on boom in the housing market. And that's what we're seeing as this pandemic moves on. Now, my take on this is probably contrary to what a lot of other economists and a lot of other people think about this. And my view on this is that if you look at housing prices just from the perspective of how much they are compared to the incomes that people make, well, you get this factor, and a lot of people use that factor and they say, oh, houses are not affordable. But in reality, what you have to look at when you're looking at affordability isn't the price of the houses, but the actual cost of the houses. And when you look at that in Canada right now, and you say, okay, interest rates have come down pretty substantially, which means the average payment has come down pretty substantially. And it's all relative to the incomes that people make. Is the real estate market overheated? Is there a massive bubble brewing? Well, I'm not so sure. Because as interest rates start to rise, well, then the cost of borrowing is going to start going up. And obviously, as interest rates are rising, that also means that inflation is typically rising, which means that incomes are also rising. So all of this stuff works relative to each other. And for a housing market crash to occur, there needs to be some sort of interruption in demand, and that just hasn't happened. What are some things that could interrupt demand? Well, you could see interest rates go up substantially for whatever reason that would interrupt demand. You could see people moving out of the country. That could interrupt demand, although we're probably not going to see that because guess what? Federal government just talked about adding a significant amount of immigrants over the next 3 years and increasing the immigration policies. So, demand is probably not going to decrease, and supply is definitely not increasing substantially because obviously with building prices going up and with a lot of slowdown in construction, that's just not something that's happening. So when you look at housing prices relative to the fact that interest rates have gone down, which means payments have gone down, and then you also look at the fact that the federal government over the last 10 years has put in quite a few levers to slow down how much people can borrow. So for example, you have to qualify at a benchmark rate now. That is significantly higher than the actual rate that you're paying. And that combined with debt servicing ratios, which is the percentage of your income that can go towards mortgage and debts, that hasn't changed much. And you just look at the fact that there's all of these things that are basically designed to make it so that people can't borrow more than they can afford. And then on top of that, there's these things like the benchmark qualifying rate that people have to use to qualify that is basically designed to prepare for increased interest rates. What it all means is that people are still buying the houses that they can afford. And until the people are no longer able to afford the houses that they're buying, well, guess what? We're probably not going to see a major crash in housing prices, and the market's pretty much going to stay stable. Now, one of the things I love about Tiff Macklem and what he has said is that he's keeping an eye on this. But in general, and this is a quote from Tiff Macklem, we believe that markets work. So you want to be cautious when you're nudging the market and you want to be pretty confident it needs a nudge. So what he's saying is they're watching the market. They haven't deemed it necessary for there to be a nudge yet, but when they do, they will do it, and they will be absolutely confident that it needs to be nudged at that point in time. And the one thing you always have to keep in mind about central banks and monetary policy is they have a tendency to overshoot. So the big news is obviously no news, but I hope this helped you understand a little bit more about what the Bank of Canada is thinking. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. We'll see you on the next one. Cheers.